Welcome to Financial Strategies with Andrew and Daniel Agemy, powered by the Retirement Income Store and brought to you by Agemy Financial Strategies in Guilford, Connecticut and Denver, Colorado.
So Daniel, I'm not sure if you remember this story. It's probably about 20, 25 years ago in that vicinity where, I was asked to perform a baby dedication at church. And after that dedication, we went over to their people's house and, to celebrate and have a party and whatnot. And as we were doing that, I don't know, something that your brother Drew did, Drew's, for those in our audience, Drew's a few years younger than Daniel. And so at the time, he's probably 7 years old, 8 years old, I think, somewhere in that 9, maybe, I don't know. But with that, he did something. I started chasing him, running after him. I was dressed in a suit and tie and had back then had a beeper. I was, really didn't have too many cell phones back then. That's how long ago it was. And I'm running around chasing this kid for some reason. I don't know why I was chasing him, but he was zigzagging all over the place and just, very volatile movement was he having as we went back and forth, and then he returned back on himself. And of course, I was probably twice his size at that point. And so it's hard for me to move. I was anywhere near as agile as him. And so then he started running and, started running toward the pool. Then at the last minute, he turned right. But guess what I did? I kept going straight and fell right into the pool. I'm Andrew Agemy.
I'm Daniel Agemy, and you're listening to Financial Strategies. Today, we're talking about don't be fooled. Drew fooled you, and I think I think you're a little off there. On you're not twice his size at that point. I bet you were 4 times his size. At that point. You're a giant. But yeah, maybe that's why Drew is always chasing kids these days. He remembers that.
He enjoyed that, right?
Yeah.
That was
crazy.
We could tell stories about him, huh? So anyway,
I remember seeing you climbing out of the pool, being like, "Why is Dad in the pool in a full suit?"
My suit and my tie, and like, oh brother, ruined my beeper. But anyway, we're talking about, that was a very volatile run, as I said, and that's Drew fooled us, and volatility, people can be fooled by volatility. I'm excited to talk about that today, Daniel. And how is it, when we're talking about people being fooled, here we are on April Fool's weekend, and how does that come about when we're talking about volatility and investments and such?
Well, what is volatility, right? And so so I think that example of with Drew is great because he's zigzagging and running in and out, and that's a perfect example of volatility. And if you're not paying attention, you end up swimming in the pool, right? And
right.
So Drew has been and continues to be a very volatile guy, but that
I wouldn't say
example
that.
was talking more about the movements, right? And so, what is volatility? Well, volatility has to do with disbursement of returns or sequence of returns, and so when we think about markets and you say, well, markets, U.S. stocks have averaged 7 or 8%, averaged, the volatility is a big deal because there's actually, I think we look back and there's no years that the markets did over the last 20 years, 7%.
Right.
It was negative 10%, or it was negative 2%. It was positive 30%, or it was positive 5%. But there's no 7 or 8% year returns. And so averages can trick us. And we talk about this a lot of times. We talk about how you need to invest it differently when you are in retirement or you are needing to preserve your wealth, or you're needing to live off your wealth, or you want your wealth to support the lifestyle that you want to have, compared to you're still in the phase where you're getting paid and that's supporting your lifestyle, right, from an employer, and you're saving to accumulate wealth. And so we're calling this show "Don't Be Fooled" because it's April Fool's Day weekend, right?
Right.
And because averages really fool us, volatility can fool us. And when I say volatility, um, people like volatility. People might not think of it that way, but we all have our different paradigms. But volatility to the upside is what people enjoy, right?
Right.
Markets since, 16 when Trump got elected they've been extremely volatile, but they've been typically volatile to the upside. And so people have enjoyed that.
Right.
But they've also been volatile to the downside. So time frames really matter. And hopefully we can explain what volatility is, why time frames matter so much when you're talking about volatility, and how maybe people can benefit from or take advantage of volatility, because maybe they've already done this in their own way without thinking about it over the last 20 years.
A lot of people do, right? Yeah, exactly. Yeah, I'm so excited about today's show from that angle. And, volatility is the idea of the price movement and in regard to this price movement within the stock market, within the market, within investments and that kind of thing. And when we're talking about that, it's a huge angle to look at, not to be fooled. I think of the guy that I spoke to probably 30 years ago now, who said, Andrew, don't talk to me in percentages, talk to me in dollars. I can't spend percentages, I can spend dollars. It's the same thing, right? That people many times will focus on, salespeople, whatever, will focus on percentages. But the question is, how many dollars is that making? In the same way, when we're talking about averages fool us. Don't be fooled by averages, is what we're trying to say to you. And when it comes to volatility, averages can look really great, but that doesn't mean that that it is affecting you in the same way that the average looks. And that is an important thing to take into perspective. So, if you just joined us, you listen to Financial Strategies with Andrew and Daniel Agemy, because people don't know what people don't know, and we're trying to educate it. So with that, we've got a paper that we would like to give to you today to help you with this, because one of the ways that people are fooled in regard to volatility and investing is with variable annuities. And we have a paper called we call it the annuities, negative spin on annuities. If you would like that paper to be able to understand things a little bit better so that you're not fooled with your annuity, especially if you have an annuity, you're thinking about buying an annuity, get this paper, call us at 800-725-7616 for your free copy, or you can contact us through our website, agemy.com, agemy.com. Daniel, when we're talking about this volatility and averages fool us, as I see, if we look at the stock market, the S&P 500, it's averaged 7 or 8% over time. A lot of people, over the past 22 years, it's averaged that kind of thing. But like you said earlier, it's never any one time that we got 7% in a year. It's ups, it's downs. And that's the thing about the stock market, right? It goes up, it goes down, it goes sideways. It's got 3 different directions. And most of the time, like you said, most people have been benefiting from the upward movement of volatility in the market over the past 5-6 years, or whatever the case may be. But it also goes down. Like right now, it's down double digit, from where off the high. Where's it going to go? I don't know, but it's creating volatility. And, that's why we want to make sure that we can't predict what's going to happen from here. So we want to be prepared for what's going on from here so that we can take advantage of that. Earlier, when you were talking about those examples of, when people are in the accumulation years versus the distribution years, and the kind of like the returns. And if they were to have $1 million, what do you think about talking about that now, or should we save that for later?
Well, there's the story that goes, did you hear about the 6 foot man that drowned in a 4.5 foot stream on average, right?
Right.
And the whole point is that if the stream is averaged 4.5 feet deep, but there's a spot that's 20 feet deep, and you can't swim, and it's a fast stream, you're gonna have some difficulties, right? And so when we're talking about disbursement of returns or sequence of returns, volatility is very, very beneficial if you're not too scared, right? And you're saving money.
Right.
So 2008, right? There was like a 53% max drawdown on U.S. stocks, just U.S. stocks. I'm not talking about the S&P or the NASDAQ, just U.S. stocks in the last 22 years, right?
And that was a drop of 53%.
Is a drawdown. Yeah. If you own those, your accounts would come down that much. And that's a big deal. There's not a lot of people who need their assets, who have saved up. You have $1 million and that's all the money you have in the world. Maybe you have a house, maybe it's paid off, maybe it's not. You got $1 million, you've done a good job, and you have a 53% drawdown.
Oh, ouch.
It's easy in hindsight to say, well, markets always come back, right?
Right.
But to be in that spot and watch your $1 million go down to, $490,000.
Right.
What do you do?
Painful. Yeah.
And so a lot of people never recovered. And it's easy to say, you guys were idiots. All those people who sold in 2008, 2009, 2010 were idiots. And I hear people say that all the time, especially on like news media stations.
Right.
But to be in that position,
hindsight's 2020,
money come down, and people thought the world was going to end, and the financial world almost did end. Is a different thing than looking back at hindsight and saying, oh, it was obvious that the Federal Reserve was going to buy assets, buy all the bad assets from the banks, and let banks recover. That's a difficult spot to be in, that kind of a situation. So how do you protect yourself from that volatility? And can you protect yourself? Can you benefit from it? And can you take advantage of it? And maybe that's what we can go into in our next segment.
Yeah. And what you're just referring to there, I just want to throw in is the lack of trust. People, when the markets come down, there's a lack of trust, and in 2008, when that happened, at the time, people forget. People have short memories. So now people forget about what it was like during that time. And there was a lack of trust, and banks didn't trust other banks. Banks didn't trust people, and just people didn't trust the stock market, and there was no trust. And so the whole financial system, and that's why they call it the financial crisis, because it was the great financial crisis, because there was no trust. And when there's a situation like that, people don't know what's going to happen from there, because it could have just all gone in the toilet, so to speak. And that's why people didn't hold from that standpoint. But, the key is the goals and what you're trying to do with that. But if you just joined us, you're listening to Financial Strategies with Andrew and Daniel Agemy. Today's topic is don't be fooled on this April Fool's weekend. Volatility can really fool us, and people's response to volatility, and the talking heads can do that as well. Well, we have a book for you that we'd like to give to you today. It goes along with this. Really easy read, only about 100 pages. Written by my friend David Scran, Financial Insanity. How to keep Wall Street's cancer from spreading to your portfolio. Now, this is a little bit outdated. I think it was written in 2011 and that kind of thing, but a lot of the information in here is still pertinent today. Some of it you might think it is not, but this is good, fundamental, foundational, how to take advantage of volatility if you understand the stuff in this book. So you can have this book for free. It's no longer in print. We have some copies available. We have, so if you'd like a copy, call us at 800-725-7616 to get your free no obligation copy. We're going to need to just verify your information after you talk to the operator, but let us know. 800-725-7616, free copy of Financial Insanity. We'll be right back after this.
I'm David Scranton, founder of the Retirement Income Store. If you're in or near retirement, are you certain you have the right retirement plan in place? Do you want to help ensure your nest egg will last you all throughout retirement? Take our retirement review quiz and find out in 5 minutes or less if you're doing everything you can to achieve a more successful retirement.
Visit us online at agemy.com. That's AGEMY.com. Welcome back to Financial Strategies with Andrew Agemy in Connecticut and Daniel Agemy in Colorado.
The two big questions people have for me today when we're doing reviews with them of their portfolio is, number one is, how's my portfolio faring in regard to what's going on in the stock market and the economy right now? And number two is, how am I faring regarding inflation? And how am I poised for that? And so recently, yesterday, as a matter of fact, I was meeting with Sally, and when I looked at when I was looking at Sally's account and talking to Sally, I said, "Hey, Sally, you remember in the 1980s, inflation was high; it was double digit, 10, 11, 12%, but it didn't matter to people because interest rates were 15, 16, 18% from that standpoint, and so it was, interest rates were far above inflation, so it wasn't an issue." Well, that's exactly, that's not what's happening today, because now we have a 1% interest rate, inflation 7%. Well, that's very problematic for most people, but not for you, Sally, because you're similar to the 80s. Because what we got for you is that, inflation 7%, but your retirement income this year has increased 21%. And we've been able to poise and be able to take advantage of what's happening. And, how would you, Sally, you're still working? How would you like a 21% raise? Well, we got you a 21% raise this year on your retirement income. I'm Andrew Agemy.
And I'm Daniel Agemy, and you're listening to Financial Strategies. Today, we're talking about don't be fooled. And that another thing that could fool people is number go up. Right. So everyone loves to see their account go up, but it really matters what you can do with that money. Right.
Exactly.
So if your account went from 40,000 to 50,000 to 60,000 to 70,000, you're pretty happy. Right.
Right.
But what if the car you wanted to buy went from 20,000 to 100,000? Now you can't afford to buy the car. Now that's a crazy example, but it really matters what you can do with that, not the number as much. It matters your purchasing power. Can you still afford to have the lifestyle that you want to have? Right.
Right.
And in retirement, that's the most important thing, is to have the income that you need to support the lifestyle that you want to have.
Exactly. And I love that, Daniel. And the thing, that happens so often is that, the purchasing power is just goes away. And in this case, Sally's purchasing power was increased, and we were able to, it's interesting when people are talking and they're like, how'd you do that? Their account values are maybe haven't grown from a year ago because of the volatility that's going on right now regarding the market price. Remember how we're defining volatility as the price movement of the market. And because of that, maybe their account value hasn't grown very much or whatnot, but their income has gone up. And like you said, that's what's really key. And if we can keep that growing ahead of inflation, then we got a real winner. And how is it that we do that, Daniel? We take advantage of volatility?
Yeah, you got to be able to take advantage of mispriced securities, the volatility of things like that. And, to put it in perspective, I don't like doing a lot of numbers on this show because most people are listening to this on the radio, and it's difficult for people to visualize numbers. People could go to, Portfolio Visualizer or something like that and put this stuff in so they could see the numbers. But we wanted to talk about some numbers to try to illustrate what we're talking about when we say when you're saving, when you're accumulating your wealth, it's different than when you're living off of your money.
Right.
The toothpaste comes out of the tube really well, but try to get it back in and it doesn't work so well, right?
Right.
But people have a difficult time understanding that because their past experiences, right, their brain's past experiences become their reality. And so even though markets have only done, over the last 22 years, US stocks have done about 7.25% averaged.
Yeah.
Like we said earlier, it's never been even. It's ups and downs, ups and downs. You had to stomach those huge downturns, right? A 37% minus year, but a downturn, a drawdown even more so. So we're gonna look at a 7.75 bond. Okay.
Mm-hmm.
Why are we going to use such a high number? Well, because we have a bond in some of our clients' portfolios right now that was issued in 2000 for 7.75. It's still out there today. It's still paying interest. It's way above par, right?
Yeah,
it's way above the $1,000 a bond that it was purchased for.
Right. But
okay.
But you could have got it back then at that price, right?
Right. So we're just going to compare that to stocks. And so if you had bought that, and we're going to use $1 million, I wouldn't suggest, unless you have hundreds and hundreds or billions of dollars, you put all your money into one company like that. But we're just going to use that as an example. Say you put $1 million into that in February of 2022, so 22 years essentially, right? Your account would be your $1 million return into $5.3 million. Okay.
Wow.
And now this had some volatility to it, but nothing like the volatility of the stocks over the same period of time. Now, if you had invested that same $1 million in 2000 into US stocks, the stock market,
right,
your account value today would be $4.7 million.
Are you kidding me? The bonds paid, got more than the other. Come on, Daniel. The market is miraculous. The market is the way that you're going to stay ahead of inflation. The market is it, Daniel. So how are you telling me that bonds did better than the stock market? Come on.
So this is back tested information. This is what actually happened. And so people have a hard time getting their heads wrapped around that. Now, I'm sure a lot of people would be happy with either of those outcomes. You invested $1 million, and 22 years later, you either have with stocks $4.7 million, or with the bond, you would have $5.3 million. So $600,000 more with far less volatility, right?
Wow. Yeah. Because people don't know what people don't know, right? And nobody, I don't think any, there are very many people probably in our listening audience that would have thought that bonds could have outpaced that the stock market overall in the past 22 years. But if you just joined us, you're listening to Financial Strategies with Andrew and Daniel Agemy. And today's topic is don't be fooled. There's a lot of information going out there that is fooling. Averages can fool us. Don't be fooled by averages, and how to take advantage of volatility, price movements within the market. We have a piece that goes along with today's show that we'd love to put in your hands if you like. It's called Negative Spin on Annuities, about annuities, variable annuities, especially the expenses on variable annuities and how they can fool you. Don't be fooled with annuities. If you have an annuity, thinking about an annuity, you need to read this paper. You can have it by calling 800-725-7616. Call now to get your free, no obligation copy. So, Daniel, we got these two things, right? Over the past 20 years, we got the stock market average, $1 million turned into 4.7, averaging 7%-ish or 7.5%, somewhere in there. And the bonds, that $1 million turned into 5.3 million. So now what? We got these two perspectives. Now what?
So that's almost exclusively what most people talk about. You didn't take any money out of your accounts.
Right.
Now, you didn't save any money either in either of these scenarios. But that's almost, when we look at returns, that's you didn't sell anything. You didn't get freaked out in
Right.
like for the stocks, for example, that 53% or that 50% drawdown, right?
Right.
Again, there's almost no year, right? You've got a 37% minus, negative year. Then you've got a 8.7% positive year, right? You have all these crazy, nothing is just up.
Yeah.
Right. It's volatile. It's volatile. But if you held for those 22 years,
Yeah.
you're happy.
Right.
So no emotion, no nothing, just that's what most people talk about.
Right.
And that's what most financial people prepare investors for. And it's if you're 20, this is what you do. If you're 50, this is what you do. If you're 75, this is what you do. And time frames really, really matter.
Secrets
because if
of
you have
returns,
liquidated in different parts of those scenarios, it could totally skew the returns.
Right. Right. That's really amazing stuff, Daniel, that you're saying that, because the volatility of the stock market. So 22 years later, you have 4.7 invested in the stock market. We invested $1 million, haven't done anything with it, just left it there. The bonds, however, did the same thing, left those there, have $5.3 million, which is amazing, right? It's a lot more money, over $500,000 more. But there's been a lot less stress with those bonds, because when that $1 million went to, $470,000 in 2008, the people with the bonds, that didn't happen. They still had those guarantees of that 7.5%, and they were in great shape from that standpoint. So go ahead with your example. I'm excited.
And with the income, so in 2008, when the stocks are down 37%,
yeah,
your bond is going to be down too, right? Because there was a lot of counterparty. People were scared about. No one knew who had what collateral, who was going to survive. Banks were really terrified that basically what happened to Bear Stearns is JP Morgan tapped him on the shoulder and said, we need collateral. And they didn't have the collateral. And that's like when the oh no happened, right? And stuff started. But with the income on that bond in 2008, even with the drawdown, you're still getting your interest payment. So you would have received almost $80,000 in interest, even though stuff is down. And that provides a lot of comfort, and that provides a lot of opportunity. Whereas instead of seeing your in 1 year, your accounts come down $40,000, you're seeing an $80,000 disbursement to you.
Right. But the thing about the bond, the thing that makes the bond safe and stress-free is that it's guaranteed by the issuer at the end of the term to get back your principal. So even though the principal may have been worth less you didn't want to sell it. It's like your house. You don't want to sell it. Doesn't matter what it's worth. But at the end, you get your money back guaranteed. You got that 7.5% every year. It's a beautiful thing. Stress-free from that angle. And like what you're getting $75,000 a year, give or take, in regard to, every year of income coming in. Phenomenal. That's phenomenal. You're listening to Financial Strategies with Andrew and Daniel Agemy. We've got some good stuff today. Don't be fooled on this April Fool's weekend. And with that, we have a book that we'd love to put in your hand called Financial Insanity by our good friend, partner, David Scranton. Don't let Wall Street's cancer keep Wall Street's cancer from spreading into your portfolio. It's got some really good fundamental principles, easy read book, only about 100 pages. You can read it through. If it's slow reader, read it through in 3 hours. So you have this for free. It's out of print, but we've secured a few copies of this that we would love to send to you for free. Calling 800-725-7616, 800-725-7616. We'll be right back after this.
History tells us the market goes up and the market goes down. What would you do if you lost half of your retirement savings? It's time to make the shift to steady, reliable retirement income. And where do you go? The Retirement Income Store. Log on to agemy.com for your free retirement review. That's AGEMY.com. The Retirement Income Store, where retirees go for income.
Welcome back to Financial Strategies with Andrew Agemy in Connecticut and Daniel Agemy in Colorado.
So I want folks to picture they're in their car and they've got a gauge on the dashboard that's showing what their current gas mileage is. And they're trying to keep that thing steady Eddie. They're trying to keep that thing right around the 30 to the mile to the gallon mark. And they're not stepping on the gas pedal too hard. They're not braking too hard. They're coasting down hills. And all of a sudden, something gets in their way and they have to step on the gas and zoom out into the other lane and go around it, or they're going to crash. And they watch that gas mileage drop 29, 28, 20, 19, 17, 14, 13, 12. And they're down to 12. And they say, my gas mileage is ruined. I was trying to keep this average at 30 and I went down to 12. I'm lost. I'm Daniel Agemy.
I'm Andrew Agemy, and you're listening to Financial Strategies with Andrew and Daniel Agemy, because people don't know what people don't know. And so we're trying to educate people to be able to make smart decisions for their retirement. Daniel, a great example of averages, how averages fool us. And we don't want people to be fooled, because a lot of people are trying to fool people today. And I think that's one of the big things that happen, why seniors are taken advantage of, because people are fooling them by using the same words they use, but different definitions. But that's a whole nother topic. Today, we're talking about the sequence of returns. Averages fool us. Volatility in the stock market can create a great some great numbers for people, but it can also create some negative aspects and consequences for people. How does that work?
Well, if we think back to driving the car, you could pull over and say, my gas mileage is ruined. I'm getting 12 miles to the gallon. It's done. Shut off the car. And that would be your average. Whatever it came out to from the 30 to the minus 12 or the 12, that would be your average. And you decide not to play the game anymore.
Right.
But this is why time preferences matter so much. Because if you're going on a 2,000 mile trip, that doesn't matter at all.
Right.
Right? Mm-hmm. So your time preference is 2,000 miles. You can recover from that, 500 miles down the road. It's not even going to be a blip on the screen. You zoom out, right?
Right.
And so that's why worrying about 7% moves in a couple of weeks, like we've seen with all this craziness happening in the world, doesn't matter if you have these long time preferences. That's where we go back to, you invested $1 million and you have 5.3 million, or you have $4.7 million. You zoomed out. That's zoomed out. That's not talking about all the pain in the meantime.
In between.
That's a long 22 years.
Right.
Whereas if you just got in the car right before you made that thing and you're getting off the next exit right there and you're shutting the car off, that's a much shorter time period. And that coming down to 12 is going to affect your return. And so when you're 30-year-old investing, you're 25-year-old investing, your time frame is much different and your liquidity needs are much different than if you are getting ready to retire or you are already in retirement, right?
Right. 50, 60, 70, right.
Because you have to do things like take RMDs, or there's maybe fees that come out of your account that you're not aware of, or there's life expenses. There's things you want, people you care about, charities you want to give to. And these things you want to be able to do even if there's volatility, right?
Yeah. Yeah, exactly. So Wall Street's terminology that, oh, you're in it for the long haul, it depends how old you are if you're in it for the long haul. I mean, a lot of times they bring it across because they're talking about from an institutional standpoint, institutions kind of go on forever. So yes, they are in it for the long haul, but individuals are not, generally speaking, because we have a limited life expectancy. And if you're 50, 60, 70, 80 years old, you have a whole lot less to your life than somebody who's 25 or 30 or 35 even. So that's an excellent point, Daniel. I want to take this opportunity to let you know you listen to Financial Strategies with Andrew and Daniel Agemy. Today's topic is don't be fooled on this April Fool's weekend. We have a paper that we'd like to put in your hands because one of the ways that people are fooled is by thinking mutual funds are the answer to investing. A lot of 401k, all 401ks have mutual funds in them. People are invested in mutual funds tremendously, but we have something that why investing in mutual funds could jeopardize your retirement. You can be fooled with mutual funds. So we want to give you this paper to help you be able to understand the truth about mutual funds. And you can have it by calling 800-725-7616, no obligation. For free. So you can have that just by calling. Ask for it by name, the paper on mutual funds, right? Daniel, so we've got these things happening here. And so I'm interested in what's happening. So what happens in that scenario, the stock market, you invested $1 million 22 years ago, you got 4.7 now. The other person invested in bonds, he's got $5.3 million now. But what happens if they were taking out money over that time? How does that affect things?
So yeah, we spent a lot of time on explaining what all Wall Street explains, right? You put your money in here, and in 22 years, you're going to have all this money. We just have to do a simple average of 7.25%, whatever. Yeah. Surprise in that scenario was that the bond actually came out $600,000 more than the stocks,
right?
With less volatility. But if you took out that bond we talked about, because most people can't find that, and we just said you get a basket of corporate bonds, long-term corporate bonds, and you put those against U.S. stocks, right? And we run the same scenario, except now because you want to have a lifestyle in your retirement, you're going to take $5,000 a month from your retirement accounts. About $60,000 a year.
Yep. Plus Social Security, whatever else you have. Good.
In that same time frame. And any guesses what kind of, which did better, the back tested the corporate bonds or the U.S. stocks?
Well, I know what the answer is, and I bet you a lot of our listeners are
bad, right?
Well, that's what people say, but I know what the answer is, and I'll bet a lot of people in our listening audience who are regular listeners are saying it right now. Bonds did better.
Well, the experiment failed in 2018.
Yes,
because the stock portfolio ran out of money. So they ran into the swimming pool, except they didn't know how to swim like you. Same $1 million, starting in 2000, instead of ending up with the $4.7 million because you were taking $5,000 a month, in 2018, you ran out of money. Whereas the long-term corporate bonds, you would have had, today, well, it ended in 18 because that's where the scenario ended. You would have had $1.5 million and your $5,000
every year. Wow.
So this is why we started the show. This is why you changed back in the day from a mutual fund, do what Wall Street suggests motto to helping retirees, because there's not a lot of people who understand this or explain this. And now our goal is not to say, well, you shouldn't have any stock exposure. You should have all bond exposure. That's not what we're saying at all. No. But what we are saying is it's different. when you are in retirement, you're serious about retirement, you want to have a lifestyle. Now, somebody could say, well, I just want to take the $5,000 a month. But like,
Right.
that's not what retirement should look like. You shouldn't have to put your lifestyle on hold
Right.
because Wall Street says you should own stocks, right? Like,
Right.
that's messed up. Your
It is.
retirement shouldn't be based upon what the markets are doing. You should be able to have your lifestyle, to be able to do the things you love and care about, and to remove that stress in all market scenarios.
Right. Exactly. And, one of the main topics of today's show is, what we're trying to bring across is volatility, which is the price movement of the market. And, market goes up, market goes down, market goes sideways. So are we taking advantage of that? And there's, you can benefit from volatility. And a lot of people think, oh no, volatility, this is terrible. What's happening? But volatility can be your friend if you're prepared for it. You can predict that volatility is going to happen because, it's going to change, right? Change is one of the inevitables: death, taxes, and change. So we know volatility is going to happen. We know things are going to change. The question is being prepared for that volatility and benefiting from it, taking advantage of it. And, through that, and that's how Sally in our earlier story had her retirement income increase 21% because she had been prepared and she benefited from volatility. This is an exciting part, Daniel, that we need to bring across to people with how they can do these things. We got a couple minutes left before we got to take a break here. But what do you have to say to that?
Well, I'm sure some people are like, well, those are great, but where are you going to get 7.5%, interest?
Right.
And what I would say to that is 7.5% can be generated by different types of things, right? So we have, for example, some indexed annuities with income riders that the people have let them build up over time, and now they're getting paid 8% on their original investments. Or we've seen some people with even higher numbers than that, right? On their original investment. So that's one idea, and there's no volatility there. So that's one example. Other things are you build a non-correlated or a low correlated portfolio where when there's crazy volatility, when there's uncertainty in the world like there is right now, you can benefit from the volatility. So as stocks and bonds are selling off together right now, gold or gold related assets are going up. And now you have the choice to liquidate something that's in positive territory and go into some of these other things that are paying income, and vice versa. When the income ones come up and the other go down, in the correlations in the portfolio is the key to make sure that you lower your volatility of the overall portfolio and allow you to benefit from the volatility at the same time.
Wow. And I know that there's a lot of professional financial people out there that don't do things that way. They don't diversify with negative correlation. I think it's a lot of names here on this road here in Guilford, and just all around, right? That typically their idea of diversification is so much in bond mutual funds, or so much in global mutual funds, and so much in stock mutual funds, so much in growth mutual funds, just all these different kinds of things. Or maybe they do a bunch of mutual funds or a bunch of variable annuities, and then maybe they'll throw some stocks in there, but none of that's negative correlation from that standpoint. And negative correlation is that when those, like what you just said, is when those stock markets coming down, when the markets are coming down, but the other things are going up, right? That they're inverse kind of to that factor, that you still can make money. So, you can still make money no matter what the markets are doing. If they're going up, they're going down, they're going sideways, you can make money. The question is how to do that, and having somebody that can help you do it in a proper fashion. Well, if you just joined us or whatever, if you've been listening to us, glad you do. You're listening to Financial Strategies with Andrew and Daniel Agemy. Today's topic is don't be fooled. We're talking about how people are fooled with the sequence of returns. People are fooled by the word, by people using averages, the talking heads out there using averages when it comes to the stock market. Don't be fooled. volatility can be your friend as well. Well, we have a book that's going to be able to help you with the topic today. It's called Financial Insanity by a friend and partner, David Scranton. And it's a real easy read book. It's his first out of 3. But the point of this book, it gives a lot of good, easy read information that will help you understand the inside and the perspective of what Wall Street has and how they want to have as much of your money in the market for as long as possible, because they make money if the market goes up. They make money if the market goes down. They make money if the market goes sideways, but you only make money if you're invested in the stock market only when it's going up. And volatility is not your friend if you're invested in the stock market. We can have that book for free. Call it 800-725-7616. No obligation to call 800-725-7616 or hit us up on our website, agemy.com. The 2 words, agemy.com. We'll be right back after this.
I'm David Scranton, founder of the Retirement Income Store. If you're in or near retirement, are you certain you have the right retirement plan in place? Do you want to help ensure your nest egg will last you all throughout retirement? Take our retirement review quiz and find out in 5 minutes or less if you're doing everything you can to achieve a more successful retirement.
Visit us online at agemy.com. That's AGEMY.com. Welcome back to Financial Strategies with Andrew Agemy in Connecticut and Daniel Agemy in Colorado.
So when I was growing up, I was the youngest of 5 children, 6 years between me and the next youngest child. So there was a period of time, I was around when all my siblings were out of the house, and I didn't have a driver's license. So anywhere I went with my mother, and she would drive. And it's kind of interesting because she had a AMC Rambler, and it was in the days before too many rack and pinion steerings were around. So it was the old kind of steering. So there's a lot of play in the steering wheel. So she had a tendency going down the road straight, and her hands would be going up and down on the steering wheel, side to side, with the car would be going kind of like side to, I get kind of getting seasick by going back and forth from that standpoint. And so, that was an interesting aspect. But then she had this other aspect to where she would also, on the gas pedal at the same time, she'd be going on and off the gas pedal. So I'd be going frontwards and backwards in the seat. I'd kind of be rocking from that standpoint. So between her steering wheel movements and her moving back and forth, the gas pedal, I'd be going around in a circle, getting, so it's amazing I didn't get car sick, but maybe that's one of the things that keeps me from getting car sick, is how I was trained up in those years. Right. But, that's in comparison, that volatile, driving and up and forth and back and forth and all those kinds of things from that angle is compared to today. We have these beautiful cars, right? My wife has this beautiful car that you just, it's so sweet. Driving down the road, cruise control, and, quiet, and just all the different things. Big comparison, a big difference between the two. I'm Andrew Agemy.
And I'm Daniel Agemy, and you're listening to Financial Strategies. Today we're talking about don't be fooled. And Dad, I think that story explains a lot. That explains why you get seasick when people are driving. You sit in the back of the van or something, somebody's driving, and you're getting seasick now. So as you've gotten older, that has hurt you, and it's not the same. You can't handle that same volatility in the driving.
When I was young, I could do it, but now that I'm older, that's not the same deal, right? Good point. Mm-hmm. Excellent. Love it. And when you talk about finances, it's the same way, right? Is that when you're young, you can do things one way, and you do things one way. When you're putting your money in, when you're accumulating money, you can take advantage of volatility through your 401k program. But when you're older and you're not putting money in anymore, now it's a different story, right?
Right. It's pretty cool when you can, we were talking about negatively correlated assets or low correlated assets. So you can generate volatility. Really means, at least the way the investment world uses it, is the amount of risk you're taking. So if the stock market is a 1, right?
Yeah.
If you take 2, that means you're doubling the volatility that the market would have, doubling the risk.
But what about the return?
If you do a half, right, then that's considered half as risky as the market.
Nice.
So you could do strategies. You could do strategy where you leverage up, right? If you take, say, a quarter of the volatility of the markets,
Yeah.
and then you leverage that up. So now you are a half, right?
Okay. Yep.
Um, but you were getting half the returns of the market before. Now you're doubling potentially the market returns at half the volatility. So people try to get fancy with these kinds of things. And there's some products out there. You were showing me a product the other day that kind of did something similar to that.
Yeah.
And those could blow up. Those could work well. Those could work poorly. But it really depends on what your goals are. If your goal is to support the lifestyle that you want to have, then you don't need to do that. If your goal is to make as much money as you can, then maybe that's something you want to find somebody that knows how to use leverage and can leverage you up and get better returns
All right.
than the S&P with a lower volatility. That's not what we're talking about, but there's different options for different people.
Right. And it's not necessarily an all or one situation, right? The big question is that you have what you need to live your retirement and not run out of money. So, we have clients where they have, some of their money set up for accumulation and the stock market because they think it's miraculous and they're enamored with the market and they've had a good experience and that's all fine. But then they also have money that is set up to be able to give them the income that they need so that they can live the retirement that they need. And especially comes into play and is important when we're talking about required minimum distributions, because some people say, oh, I'm going to leave the money in the market, for the rest of my life. I don't need it. I got enough pensions and Social Security. I don't need it. Well, when you're 72 years old, you have to start taking out, your IRA money, 401k money, that kind of thing. And so do you want to take it from principal or do you want to take it from income? And so that's a whole nother scenario that people have to take into consideration. That's why we say to people, don't try this at home, because there's second, third, fourth, movements in regard to consequences. And so with that, you have to make sure that you're in the right place with that. Well, you're listening to Financial Strategies with Andrew and Daniel Agemy. Today's topic is don't be fooled on this April Fool's weekend. Averages can fool us. When people talk in averages, it's the same way as percentages can fool us, whatever case. But one of the things that people out there use and take advantage of the public with, not necessarily on purpose, folks, but is mutual funds. And we have a paper we'd love to put in your hands that says why investing in mutual funds could jeopardize your plans for retirement. It may not work for you in retirement. It probably won't work for you in retirement the way it has worked for you as you're building your portfolio if you need that money. So we like to put this in your hand. Just ask for the mutual paper on mutual funds by calling 800-725-7616. 7616. We'll send that with no obligation, free of charge. Daniel, we just have a few minutes left in today's show. We want people to be aware, to know what they don't know so that they can at least ask the questions that they need to ask. And find out what they don't know. What can you say as we finish up here? I'm interested in how, types of things maybe people can take advantage of volatility or what do you have to say? I know you got a great mind there. What is it?
Well, it's about positioning, right? You need to be positioned for a volatile world because I don't think anyone in their right mind could say that we don't live in a volatile world right now. We've put up with riots and looting and mandates and non-mandates and this and that and whatever for the past couple of years. Now we have inflation and then we have this war or skirmish or whatever it is in Russia and Ukraine. We got central bankers talking about starting a new reserve currency. We've got central banks buying up gold. We have all these crazy things going on. And we have price swings, when definitions of volatility, they're talking about volatility is, more than 1%. And we're talking about over the past couple of months, 7%, 8% swings. It's been crazy. So with a world that is so volatility, of course, asset markets are going to be volatile. Do you need that volatility in your retirement? I
Good
wouldn't
question.
want it.
Right.
So I don't even need that volatility in my life not being retired.
Right.
And so how can you position yourself to that? Some people say, well, bonds are bad because there's inflation and you're going to lose everything.
They don't know what they don't know.
Right. And I'm sure when we talk about that bond that was issued in 2000, that was, 7.75%. People are like, well, don't buy that. Rates will go up higher. And that hasn't happened. And so the point is to have that diversification that allows you to do different things. So if you're talking about buying a 40-year bond right now at 2%, maybe that is a really foolish thing to do. But if you're talking about getting, 3 or 4% for 2 years,
That's not
that's
bad.
a whole nother scenario because it gives you optionality because it's not going to fluctuate a lot, which allows you to potentially sell it in tough times. It allows it to come due in tough times. And as that keeps your portfolio stable, it allows you to have stability in your portfolio. And then it comes due into cash. And if other things are down or having better yields, it allows you to reinvest that money at better rates. And that's kind of how you asked earlier, well, how do you increase somebody's income by 20%? Well, being positioned properly allows you to take advantages of situations like right now, especially, international debt. International bonds have really sold off because nobody knows what's happening. So if you're positioned well, you could take advantage of some great income.
Right.
But if you were all in stocks, you're going to take a huge loss to be able to participate in this. It doesn't make sense. And so when you keep talking about mutual funds, you're talking about these things. The point is funds of funds, all buying the same stocks does not help you. You need true diversification to allow you to have income, negative correlation, and to be prepared to take advantage of buying opportunities, dips, and things like that.
Have a customized portfolio, a customized plan for you that from the people that know you and are investing for you, as opposed to a mutual fund that doesn't know you from Adam, right? So that's cool, Daniel. That's actually, what I think of when you say that too, is those people out there that, they've lost a little bit of money in the market right now because its market's come off the peak and they're saying, oh, I'm waiting to do what you say, Daniel, until the market comes back up. And I saw that happen in 2002. I saw that happen in 2008 where when people, go down a little bit, and then people would say, oh, I can't do anything now. And then they say, I can't do anything. And they keep going as the market went down. And then, pretty soon it was without it, but it's still a good time to make moves, to make changes, because there's some good opportunities out there for you to be able to take advantage of the volatility that's going on. So the question is, are you going to take advantage of the volatility, or are you going to sit back and wait for stuff to happen? Are you going to make a decision on purpose or are you going to make a decision by indecision? You've been listening to Financial Strategies with Andrew and Daniel Agemy. We've glad to have you with us. Hope you come back again. Thank you to our loyal listeners out there. We've got a book for you today. We've got about 5 of these books available called Financial Insanity, How to Keep Wall Street's Cancer from Spreading Your Portfolio. Now, this is a book that is a very easy read book and will give you some good potential or some good perspective on what's going on during these volatile times. Even though it's a little bit outdated, it is still going to give you some good perspective and easy read. Could probably read it in 2 or 3 hours. But you can have this book by calling us at 800-725-7616. No obligation. It's not in print any longer, but we have some copies available if you want it. 800-725-7616. Until next time and forever, you too can have a stress-free retirement.